Thanks to all of you for joining us today. To kick off, it'd be great if you could each share with the audience a bit more about your firm and the type of companies that you work with. And I'll come to you first, Cam.
Yeah, thanks, Erica. And thanks everyone for joining. As mentioned, I'm a partner at Fort Capital, and we are a boutique investment bank based in Vancouver, 60 people across 3 offices in Canada, really with a goal to be the natural home for tech, and to work with companies from seed to exit along this chaotic journey we're all on, whether that's raising capital, raising venture debt, M&A, strategic growth advisory. I felt passionately as an operator that there was a need and a hole in the market for an independent group to help companies scale. So that's where I'm at.
Awesome. Thanks, Cam. I'll come over to you next, John.
Sure, yeah. At Vistara Growth, we invest all across North America in growth stage technology companies. Loosely defined growth stage is 10 to 100 million ARR. And most of our portfolio are in the kind of 20 to $50 million range. So a bit further along maybe than some of the groups on the panel here, or some of the investors are people wanting to learn more, but hopefully can share some insights of what we've seen of companies who managed to get to that stage. We invest across the capital structure in both debt and equity and everything in between, converts and hybrids. So really looking to find creative ways to work with companies, primarily in enterprise software and B2B SaaS, but also tech-enabled services too.
That's awesome. Thanks, John. And Maria, over to you next.
Hi, everyone. So Pender Ventures is a pan-Canadian firm, I guess. We have offices in Vancouver and Montreal. We like to invest across Canada, although we can invest technically across North America. We're a B2B tech investor, pretty broadly defined across a number of verticals, and we'll go horizontal as well. But we really focus on companies that are kind of data-centric at their core, which does mean we do mostly software, but we'll consider hardware. And our biggest vertical is health. That's a vertical we think that Canada punches above our weight in, and we're very excited about. We tend to invest 2 to 3 million initially, and then lead rounds. We invest at what we call the inflection stage point of a business. So kind of that product market fit, as opposed to defining ourselves by necessarily financing stages.
That's great. Thank you all three. And we did the poll just a moment ago, and you guys saw in the results, 42% said that communicating an investable vision was the most challenging. Next down from that was 32, determining their valuation. And those 4 kind of answers, we're going to talk about a bit about them in a moment, but I'm curious to get some of your initial kind of feedback on those results. Are you surprised? And can you share some thoughts on what is some of your advice in that area? So maybe I'll come to you, John, first on this one.
Yeah, not necessarily surprised. I think probably all 4 of them cause challenges at different points in a company's life cycle. But maybe to the investable vision one, I think I was thinking about this in advance, and I think it's all about communicating the various stages and components of that. So what is the pain point you're looking to solve in the first instance? Why do you understand it better than other companies? Is it from your background as a founder, your experiences, and then communicating how big the market is with your own kind of individual lens on that? Why are you the group who are going to solve it? Your team and your company and your vision, and then how are you going to monetize that through a business model? What business model makes the most sense to address that pain point, but that you're specifically trying to solve as the most capable founder and team to solve it?
That's great. Maria, what are your thoughts? Were you surprised, or did that all of them are pain points? All of the above would have definitely been 100%.
Yeah, I feel like if that was an option, that's what everyone would have chosen for sure. So I'm not surprised. I think number 2 was valuation, also not surprising. And interestingly, I think probably the first one, which was about how to kind of communicate, do investor relations. So, and so I think the more you do actually that number 1, the better you can hone in your story actually. So, and then build the relationship and trust over time with the investor, and then you kind of learn about the ones that you want to do business with. So, but on that point, I mean, I think John's framework was fantastic. Just maybe honing in on that value prop. I think it's really quite important to discuss, you know, how your product or to be built product is going to solve a real burning problem, and that there's some sort of pent up demand would be helpful. So maybe it's industry tailwinds, some new something new that's developed in the market that's really going to be the why now. I think in that kind of storytelling, the why now is quite important. And as John said, you know, why you? And then even taking it to the point where you can drive, even if it's theoretical, because you're just maybe at the alpha or beta stage, the ROI or the payback that your product can provide. So there's something tangible, might not be there today, but in the future, and you have some good thesis around that.
That's great. Thank you. Cam, over to you.
Yeah, not a surprise at all for me. The investable vision was number one. I'm trying to figure that out too. I mean, I think the reality of the last 2 years has been, with venture activity so low, it's not so much, I mean, you always need to tell a great story and connect with investors and talk about the vision. The part of the challenge right now is understanding what investors want to see. You know, do they want to see rapid growth? Do they want to see profitability and cash flow positive? That has a huge impact on the kind of team you build, how you sequence certain things in the company. And without momentum and lots of deals to sort of point to over the past 24 months, it's tricky. Sometimes even while we're raising money for a company, messaging from investors can change to, we'd like to see more growth, or we'd like to see a smaller team and more profitability. So I think that's challenging. I have a lot of sympathy for founders right now, because it's hard to know exactly what you're aiming for.
Yeah, absolutely. Kind of looking at that through the current landscape is really helpful for sure.
Yeah, I think maybe just to add one thing
Yeah.
to the comments as well. I think as an investor, you really want to avoid investing in a situation where it's a solution looking for a problem. So you might have this cool technology, but you don't really know what pain point it's specifically going to solve and how you can build a business on the back of that. So I'd encourage people to very much keep that in mind. We have this cool technology or, you know, interesting innovation, but where exactly are we going to point this in the market that people will really want to buy it to solve an issue that they're facing on a daily basis?
That's great. Thank you. And I realized I didn't mention at the top, but we have a lot of folks on the line today who are BC Tech members, folks on the line who aren't BC Tech members. And, you know, as you're facing some of these challenges and looking for resources, I do really encourage you, our startups, to sign up as BC Tech members to get connected in with folks like the folks we have on the panel, attend some of our events where you can gain advice from some of these amazing companies and connect with other people in the ecosystem. So I'll just ask the team to drop a link in the chat. Our BC Tech for Startups membership is completely free. So if folks have a moment to multitask, you could do it while you're out listening to the call, but it'd be lovely for folks who aren't members to take a look at that and join with us today. Anyway, short infomercial from me, guys, sorry. But we'll come back to the topic at hand. So digging a little bit deeper, you know, presenting your business plan, as we said, to potential investors is a really critical skill. So I'm really wondering if the three of you could maybe share like your top 3 tips for companies who are pitching to investors. What can they do to be successful? Maria, I'll come over to you on this one first.
Sure. It's actually going to be very similar to, I would say, that, you know, communicating that investable vision. Our framework that we kind of have in mind when we're looking at meeting new teams or new opportunities is what I call the 3 Ps, which I learned from someone else in the industry, and that's people, product, and pent-up demand. And so really articulating this investable vision that we talked about, so the whole value prop, really how your product is solving that real problem that John alluded to is key. And then also the pent-up demand is connected to the market, the why now, and how big your market is. There's plenty of great businesses out there, but if you're not part of a massive market, you might not need the capital, nor should you raise a lot of capital, perhaps. Or there's maybe alternative sources of capital, because if the market's not that big, you want to keep more of that, you know, obviously for yourself. So I think that's really important to articulate, and also shows how well you know the market, how it's growing, how there's maybe some unique dynamics that you need to consider in that market, how pricing might work in that market. And then on the people side, it's really all about, why are you, the founder, CEO, able to attract, maintain, and grow and motivate your team. It's rarely that, a company's successful because of one person. But even if you have, 4 or 5 folks that are willing to join you once you close the financing, that's fantastic. That demonstrates your ability to sell a vision to others, employees, and then obviously customers down the road. And then thinking through, the other 2 points on product and pent-up demand, and even your unit economics, all of that kind of shows that if you take capital, how you'll allocate that efficiently. So, the top kind of qualities we look in people are obviously their character and their ability to hire, but also their ability to allocate capital really well. So I think those are the kind of the 3 key areas that we would look and concentrate on.
That's great. Yeah, and we did, kind of touch on this a bit in the earlier result, but Cam, any other thoughts, or do you have a 3 Ps or similar to share?
I wish I came up with something clever like Maria just did. I got to come up with one right now. No, I think for 3 points for me, I would say most recognize what your customers are dealing with. They're probably buried in too much tech as it is right now. So when I'm looking at deals and looking at new early stage companies, don't forget to tell me how you're going to go to market versus just about the technology. And sometimes I think there's just as much innovation and much interest from investors in how you're going to go to market efficiently than just talk about the LLMs or the whatever the tech is. And I've been, with my own businesses, I only wanted to talk about the tech because that's what I'm passionate about. But keep in mind, investors want to know that how you're going to maximize every opportunity to grow this thing efficiently and scale it. And what I see with tech companies is often the tech is the only thing that scales and operations don't. So just keep that in mind, that investors are really going to want to know that you understand the how, not just the what. Be realistic. Crazy revenue projections, don't think you need to put those in because you don't think you're going to hit them and I don't think you're going to hit them. Being realistic about how you're going to grow and scale helps reinforce this big vision. So it's not a weakness, but be realistic that some things are going to be hard. Don't be afraid to admit you don't know certain things, but be super deep on others. And it just builds credibility. And that's something it's just a great thing to build into your pitch. And also be curious. It tells me about the type of leader you are. Ask questions, because when you're talking to someone like Maria or John, they've spoken to hundreds of companies and learned a huge amount. And you'd be surprised what kind of real human relationship you can build with people. Even if they don't do the deal, they'll be an advocate because they know you're engaged and can build relationships. So I'm over-indexing on sort of the human side of things right now, but I do think in a tough market, don't be afraid to build really deep, transparent relationships with the other side. It's helpful.
That's great. Yeah, that honesty is really important. John, you already gave us some truth bombs earlier, but I'm interested to more of that.
I don't know if I characterize them that way, but maybe just a practical piece of advice is make sure the audience that you're pitching to is the type of group who will invest in your type of company. So if you're a consumer app, don't go and pitch a software IT infrastructure investor. How you would pitch Maria's group would be very different to, say, Vistara. If you're 3 million ARR and we're at 10 million plus ARR type investor, don't waste your time with us, so to speak. Focus your attention on groups whose mandate fits what you're looking for, if it's seed or Series A or whatever it is. So just be very mindful of that. Or if you're pitching an angel investor who made all their money in real estate, a deep tech product, it might not be the best fit. So just keep that in mind. Maybe to extend what Cam said, be very focused on being customer focused. So show that you're thinking about ultimately what your customers will look like and how you'll best serve them. And then something I've observed between all of the founders we've worked with and the scale of company that we invest in, just be really responsive. Some of our founders are kind of maniacally responsive. It never ceases to amaze me. If an investor asks you for some follow-up information, just get it to them really quickly, and it just goes a long way. And then I'll come back to it later, but I think that's something that's very important.
That's great. Yeah, I think resonated across all of it. That building of the relationship is really important, and the trust One of the earlier one of the answers in the poll was around valuation, so maybe we'll touch on that a little bit now. So many founders struggle maybe with how much to raise. Can you guys share some advice on valuations and how to attract funding at the right level for their ambitions? Maybe how to balance that. Maybe I'll come to Maria. Come back to you on this one first.
Yeah, I'm so glad, Erica, that you asked this question. It is, obviously so important. And, coming off the heydays of 2020, 2021, and, I think probably encouraged by my own peers, I think there was a big message out there to take as much as you can, and as often as you can, because money was basically free at zero interest rates and there was lots of capital around. But that's, I think we're in a very different market now. But in any market, I believe that companies should think differently about that. And the why is because there's consequences of taking, too much money or too little money at too high a price, et cetera. So I do think you need to, as the entrepreneur, need to kind of sit down and think thoroughly about your business, almost to playing it forward to an exit potential. And it's obviously very hard to do if you're just starting out, but there are sort of some rules of thumbs and some ideas given your market size and how much capital you think you'll need to build the team, and then work backwards. When you work backwards, you kind of think about the milestones that can happen along the way. Those milestones are important because they're going to be, assuming you hit them successfully, your valuation driving events. And then, break that number down into those different stages. And as all of you must know how hard it is to build a business, you don't want to spend all of your time fundraising. So, raising enough to get you to your next key milestones is, probably the right amount. And the milestone should be, thinking through what those milestones is quite important. They need to be kind of show you demonstrate key levers in your business where there's indication that there's customer validation, there's maybe your pricing validation, there's maybe a feature validation, where then you can better understand how much money you need to get to that next level. So thinking through that really carefully is key on the amount. And, I really want to emphasize this is not, shouldn't be perceived as being conservative, because I think Canada gets kind of that rap. It is really about being thoughtful about your ambition, because your ambition might be different than the ambition or potential of the business at this stage, but it could change, right? You might in fact discover that you have a much larger potential market size 2 years in. So you thought maybe you needed 10 million, but it might turn out that you need 50. And so there is always money for great ambition and great companies. But thoughtfully staging it out is, I think, absolutely important, regardless of whatever market cycle.
That's excellent. Thank you, Maria. John, your thoughts on valuations and how to strike that balance?
Yeah, I'd probably pick up on something Maria mentioned around working back from an exit. I think when you start out and found a business and they are thinking about fundraising and valuations, I would encourage people to work back from the end goal. So do you want to ultimately ring the bell in the NASDAQ and IPO? Do you want to maybe sell your tech and team to a strategic acquirer? Or do you want to build a lifestyle business that funds your lifestyle for 40 odd years or whatever the time period is? And they're all different paths and can make sense for your personal goals and also for the market that you're operating in. So if you plan to build a lifestyle business, and there's nothing wrong with that, it's often a pejorative term, maybe be mindful of raising as little as possible, minimize dilution, maintain control, and bootstrap as far as you can. Maybe if you're building a deeper tech product, it makes sense to raise some, but just be very mindful of that. So there's no right path necessarily. So I'd encourage you to think about what's my end goal and how do I work backwards from that, as opposed to maybe thinking seed, Series A, Series B, Series C, etc., which is a bit more traditional, if you like.
And we're both nodding, so I'll come to you now.
John sounds very smart. I agree with him. No, I I think working back from an exit, I took a huge amount of value in that with my own businesses, because I think you're almost programmed to think it's like a dirty secret you have to be thinking about, versus when you have, I always kept an exit strategy document alongside my business plan. And I found like thinking that through helped me think about how I was going to go to market, the types of partners I wanted to work with, the kind of optionality I wanted to build into my business. Because if I'm going to go through resellers, if I get it right, it's likely that some of those resellers are going to be a likely exit opportunity. And the kind of APIs you build, accelerate the integration with that partner, which makes you more invaluable, which leads to an exit. So I think there's some go-to-market components that can, I'll come back to that. But on valuations, I just want to touch on a couple of things. I see two things. One, crazy high valuations that are just going to be an anchor for you. You're not going to get funding on it. You're going to hold a line in the sand and demand something that I think can be, you need to be flexible. It's often it's going to be a conversation with a lead investor around where a valuation is. And if both sides aren't comfortable, that's fine. But I think you're going to be working with investors for a long time. So holding out just for the highest valuation might can lead to some poor decision making around the kind of relationships that are important to you and how you work going forward. And also, I've also seen the reality, and I'm sure we all have, of companies that raise at a really high valuation. That too can be an anchor, because you can't catch up to that valuation for that next round. Options are underwater. Like it becomes this ghost you're chasing you can never quite catch. So be realistic. Now, on the flip side, is I worked with a great company locally a couple of years ago. When they first presented the business plan to me, their valuation expectations were so low, I was like confused. It was a great story with a big vision, bootstrapped, profitable. But the way they saw their TAM and their market, my comment to them was, let's spend 6 months working on this story, because I actually think you're missing a huge part of the TAM here, and your valuation, I think you could raise at a much higher valuation, and they did. So every once in a while, you see something that is irrationally modest, very Canadian. And so being realistic, I think, will help.
Can I just add on to something that Cam said? Because I thought it was a very important point, and that's having that exit thesis, because I think it's important for the audience to know that investors will have an exit thesis. And it'll be different depending on the type of investor. And we actually share it with our teams that we invest in, and we look at it, we refresh it. And it's more about having that discipline. And we do need an exit at some point. We have investors as well to answer to. And what this actually does is really help form that ecosystem map of potential partners that you need to be thinking about, from a business perspective, and then potential exit down the road that, groups like Cam's can help you with, obviously. But I think it's important to know that, at least for even our position, whether you're a seed fund, a later stage fund, growth fund, debt fund, we too have exit thesis that we're working on.
Thank you, Maria. That's excellent. Now, obviously, it's come up a little bit through our conversation, the current landscape, the current market. I joked when I was prepping the panel that I was going to ask you guys to bring your crystal balls with you to give us your thoughts on the future. But what I will ask you is, what trends are you seeing now? And maybe some advice for folks on the line about how they can best navigate during a bit more of a challenging time. So I'll come to Cam on this one first, unless you brought your crystal ball, and then you could.
Yeah, it's enormous. I can't bring it into the screen here. No, things I'm seeing right now. Well, first of all, from the operations side, I think what we've all seen in tech over the last couple of years is that companies overbought technology during and post-COVID. There was a lot of spend. Procurement was relatively streamlined. The net result of that is that companies are buried in tech. So all the groups we're selling to have either overpurchased or they're trying to reconcile costs. I think it's leading to longer sales cycles, slower sales cycles. So on the operations side, one tip I would have is to really try and maximize that go-to-market efficiency. Think about how you can scale using indirect partnerships, how you can maximize all the outreach there, because I don't see that changing in 24 into 25. I think we need to be, companies that over-indexed on growth and we're able to raise, the team composition you have. So think about, you might have a really, really amazing sales team, but do you have a great retention team? So think about the composition of your team, because the team that is great at growth might not be great at upselling years 2 and 3. And investors are looking at retention and they're looking at churn, and it looks like a reflection on the technology or that people don't want it. But the reality can be you don't have a great enablement team, training team, materials that drive engagement with a customer that's overbought spend and isn't using a lot of stuff that they bought, even though the technology is great. So make sure your team can get you through the life cycle of that engagement with a client. I think that's really important. And then on the funding side, I think we're all in it, right? It is trying to understand where there's going to be momentum. I touched on it before. What VCs are looking for, the KPIs, they want to track growth versus cash flow positive and metric. All of that is, I'm seeing clients look at all options. Is it, keeping safes open, venture debt, a minority sale. I mean, I've never seen founders and investors that I'm working with talking about private equity in ways that they wouldn't have 2 or 3 years ago. I mean, I think the reality is liquidity and exits are top of mind. Sales cycles are longer. Exit cycle, on the M&A side is longer as well. But I think people are looking at all possible options to fund their business. And hopefully there's some good creative solutions and some efficiencies that come out of this right now while we're waiting for the market to pick up.
That's great. Thank you, Cam. John, what are your thoughts?
Yeah, I'll pick up on something that Cam mentioned there in terms of thinking creatively. So specifically to fundraising, as you're thinking about what the best options are, I'd encourage people to be creative and not just think about traditional VCs. There's a lot of angel investors, family offices out there. So maybe just think a bit more broadly, look at people who've had exits in the space you're looking to invest in, for example, and maybe target them as well, because they might, as well as capital, bring some value add as an advisor or a board member too. So that's certainly a trend we've observed. There's just a lot more pools of capital out there that are available, be they the types of groups I mentioned, or even as Cam mentioned, debt or private equity or things like that. So just keep an open mind and try and bring people on board who can add value to your business. Then in terms of managing challenges, again, what I've seen successful groups that we've encountered do is just make the painful decisions early as opposed to waiting. So if you see some headwinds coming, make the tough decision to cut burn as quickly as you can, get ahead of it, because it's much harder later to do it. Whereas if things aren't as bad as you anticipated, you can always bring more headcount back and invest again in growth. So I'd say just, make the tough decisions as fast as you can, and you buy yourself more optionality down the line.
That's great. Maria, your thoughts?
Yeah, I have a lot of thoughts, and I'm just often reflecting how every cycle is quite different. So maybe I will try to crystal ball a little bit, because the slowdown was not quite as dramatic, but much more all around because of all the macroeconomics and geopolitical, not to mention that was going on at the same time as, the very specific impact to technology. And I do think it'll take a little bit longer than we all think because of all those other factors. So given that, kind of 3 things that I'm thinking about and maybe would provide some advice on to the audience are, we do still find a bit of a disconnect and expectations on valuations. It's way, different than even last year. And it's not just for financing, it's also M&A. What a customer is willing to pay for a product, all that kind of thing. So there's still that disconnect. So insofar as it impact on the financing, which I think is mostly the audience right now, my advice would be kind of waiting out that game. I think that both of the panelists mentioned before, you want to balance like waiting for that higher valuation to like, if I take that money in now at a lower than I like valuation, but it does help me build value faster and de-risk, getting to that actual value creating event. Because remember, taking in money in and of itself is not value creating. It's actually what you do with it. Is something I think an entrepreneur wants to balance. There is going to be a price at which maybe you should raise and carry on with your business. And kind of tied to that is kind of this impact of overall macro. I think when interest rates were 0, inflation almost there, we could just put our heads down and build businesses. But I think that entrepreneurs really need to think about how the macro, whether it's supply chain issues, interest rates, inflation, is impacting their customers and their sales cycles. And that's really key in how you're thinking about your business. So you do need to really think through your customer vertical or what have you, and how that's impacting your business. And then the third thing, of course, is AI, the impact of AI. And it is, impacting us, like personally, business-wise, et cetera. I think there's a lot of short-term hype for sure in certain areas. But long-term, this is going to be, such an important trend. And how you are, if you're not already incorporating it into your business or it's a key part of your product, you should be thinking about how you will be doing that, because it will become table stakes. It will. And certainly when we look at companies, that's something we review, even if you don't have today, but how you're thinking about it has to be a key part of your thinking.
That's great. I might come back to the rest of the panel members to see if you wanted to add anything on that.
What I'd add to that is, I touched on it a bit earlier, but don't get so caught up in the tech. Think about how you're operating. And I think we all need time and to maximize every dilutive, non-dilutive option, every financing option, every revenue growth option. But don't over-index that the tech will get you through. So really think about how you can creatively build the business and efficiently build. And it can be, AI is great because it just makes things you do well already, maybe a little more efficient. But I think it'll help you build a more scalable company, because I've seen companies struggle with huge viral growth because operations couldn't keep up. And right now, the last thing I'd mention on the M&A side are typically at Fort, we're 50-50 sort of from a revenue point of view between raising money for private companies and M&A. I'd say that's 80-20 right now in terms of M&A. And I think that's both good and bad. There is lots of capital to deploy. Good companies are getting great exits. And we've seen that ourselves in the tech sector and the tech deals we've done recently. And also, when things come up, make sure you're prepared. You never know when that huge opportunity is going to come up and present you a strategic exit, a big round. Don't wait until the last minute to get your house in order internally on understanding what a deal room looks like, what financials you need to have, partnership agreements, all the basics that we all talk about, but it often gets pushed up priority number 20 when you're trying to grow a business and hire people and build new tech. But you can miss your opportunity by just waiting too long for that. And so I would say just have your ducks in a row internally so that if you want to take that exit, you're ready to go.
Thanks. John, did you want to weigh in?
Yeah, maybe just one other thought. I'll maybe give Cam his ilk a bit of a plug here. Advisors can be really helpful. So as you're doing, financings, they may be expensive on occasion, but hire a good lawyer. They pay for themselves over and over in the long run. And even on the capital raising side, while sometimes it makes sense to try to do some of it yourself or complete it yourself, advisors can often be very helpful as the referee in negotiations, just so you get off on the right footing with your investor once they're in the tent, particularly for later stage companies. So I'd say that's something to keep in mind. Don't necessarily think of advisors as a nice to have. Sometimes they can be really helpful and add a lot of value.
Sorry, that didn't click. I just want to give a quick shout out as well to our audience. They've been posting about their businesses in the chat. So for our panel, we want to take a look through on that maybe as we close out the session in a few minutes. But some really fantastic BC Tech members here talking about their businesses. A few have raised questions, so I'm going to come to that now. Mike Rodenberg of Square Knot Analytics asks this question. He asks, how does someone communicate a more complicated problem that involves solving problems for both consumers as well as businesses? We are a B2B2C business, and we solve problems on both sides of our business. It makes it challenging to figure out which problem we should focus on in our pitches. Any advice from the panel? And if we needed, we can ask him a follow-up question and see if he can unmute. But any thoughts, John?
Yeah, I'll hit a one-line response. Whichever one is paying you is the one you should focus on, would be my suggestion. that's the pain point that you're solving because they're the ones you're earning real dollars for. And then the subsequent, say it's the B2B and the B part are paying you, the C part then is a secondary problem to my mind.
Great advice. I see nodding heads. Cam, Maria, anything else to add?
One thing I experienced, I was raising money for quite a complicated digital health company. And I made when I first went out, sometimes the complication, your first instinct is let's simplify this into language that resonates with a broader audience. And sometimes simplifying can actually do more harm than good, because you recognize that in certain areas, let's say in could be mining or health or tech, whatever, there's a huge cohort of investors that understand the complexity, and it's not a negative. And sometimes simplifying it takes away from the true value. So you don't want to overcomplicate things because unnecessarily. But if it is a specific solution to a specific problem, don't try and generalize it, because that also can take away from the upside of the story.
I don't have too much to add other than to sort of say, even if you talk, simplifying doesn't have to be, it's more about focus in my mind. So you don't have to solve all the problems right away. And so you can speak to or spend maybe more time on the problem that's paying you money right now, as John said, but don't, play down that bigger story. So I think it's sort of almost the way you present it chronologically, almost, on how you're getting to that B then to the C, might be helpful.
That's great. I also have a question from Phil of Sea Change Labs. The first part of his question is, are impact investors a real thing? But I think the real question is the second part. If you have a decent business with amazing impact, how can that amazing impact lead to investments? That's, I think, tying back to our communication of the vision. But on the kind of like impact side, would any of you like to weigh in on that?
I'll maybe start off, because we feel pretty passionate about impact. We don't call ourselves an impact fund because that has a lot of other connotations for a fund. So yes, absolutely. And there's actually I think quite a bit of capital, particularly actually here locally, if you're local in Vancouver. I think the challenge is what impact means for your opportunity needs to be well articulated. And ultimately, quantifiable in some way. And so, I think that's absolutely key. And by the way, I think lots of data has shown now that, products or companies or investment funds that invest in impactful areas have the same, if not better, returns than others. So the data now shows it. So you should not, worry about presenting that you're going to have less returns, but you're making such a great difference in the world that you do not need to do that. There's lots of good data. And in fact, we have data in our Fund 1, soon to be Fund 2 as well. And so we actually also spend a lot of time thinking about how we can help make an impact post our investment as well, and working with the company.
Can I add one thing, Erica? We do a lot in climate tech. And I'd say that's an area, for example, where there's lots of impact investors. One, back to that previous question on complexity, you may find, you have this overlap in investors where you might have a SaaS platform, it's B2B, but really it's a very specific use case, and say in climate tech, some sort of initiative. An impact investor might be a little deeper into the domain expertise of a space to see that the delta between where you're at and where you're going, and live in it a little more often, to get in earlier, for example. So I think they are real. They can be super helpful. We do a lot of work especially in climate tech all over the world with impact investors, and they exist in lots of different domains, and go find them. They're not unicorns.
Awesome. Maybe I'll come to the next question here. I'll jump down to, what are your thoughts on pre-sales to raise capital in the early stages? With customers already interested in your solution, how would you work with them to invest earlier instead of waiting for the whole solution to be ready? I'll throw that out to whoever wants to jump in. John.
Yeah, I think it's a fantastic idea. Like, customer revenue is the cheapest form of financing you'll ever be able to access. So if you can get a customer interested, maybe provide a discount for a longer term commitment, collect as much as you can up front to extend your runway, and then early adopters can be a great way to iterate and improve your product. So get close to them, get feedback from them, invite them to review your roadmap, things like that. They can be a very helpful source of not just cash, but also insight as well.
That's great. Thanks, John. Maria or Cam, anything to add there?
Yeah, I couldn't agree more. Like it's a win-win. Obviously, you're winning from validating your product feature functionality. And I agree, you just kind of cage it by the time-based, the discount, or maybe geography, what have you. But if you're you can easily upsell as you build up more features. And then it's a win from, if you are fundraising, we would love to hear about that. And paying customers are always the best way to win the hearts of investors.
I have one point on that, probably from what Maria said. One of the businesses I built started life as a services company. And I know that can be a tough thing to raise money for everyone out there. But right now, when we're looking at all options on the table, to de-risk a lot of things, working with companies that are solving real problems, driving real utility, it might be services revenue, but if you are building a business, you can build real trust and relationship with big brands. You maybe on a fee-for-service basis, and then you find that thing. You find that moment where you have this repeatable problem that now you know when to double down on whatever that tech is, whatever module you're building. There's always that service revenue multiple thing, but right now, giving yourself a better connection with customers, maybe a bigger enterprise opportunity, de-risking a lot of things and building those relationships, I think is a great option right now. Give yourself more runway.
That's great. I appreciate the question from the audience on that. I'll just take one more, and then I have a final closing question for the panel. Just a little bit earlier in the chat, they asked for advice. Advice for where to find angel investors, high net worth individuals. How do you get in the door, get their attention? This might be a bit broad, like how do you get started? How do you start those relationships? So any advice from the panel on that one?
Okay, no one, go for it, Maria.
This is probably obviously in your key area, Cam, but I mean, there's fantastic sort of accelerators, a lot of events that BC Tech, here's a plug for you, Erica.
Waiting for that.
That obviously there'll be angel and high net worth investors in the audience. There's, fantastic accelerator programs. I think everyone's familiar with CDL and, a bunch of others. It is mostly, angels and former operators or current operators in the room. And that's just fantastic. Gives you that much more insight. And then when you have a meeting with someone, ask for another intro. Like, I think there is that network effect. It is certainly in Vancouver, 1 degree of separation almost. So, I think that networking will really pay off in spades.
I built my last business. We didn't have any money. I think I owe LinkedIn a lot, to be honest. It was just old-fashioned networking. When you have no money in your early stage company, your network is everything, right? And treat people well, they'll help you out. Ask for help. People love to give advice. Be relentless on outreach. Tell your story. Be curious. I know this is nothing new, but basic, but people are watching, investors are watching how you operate as much as what you're building. And finding those great angels, those early sponsors, they probably don't understand what the tech is, but they really gravitate to what you're like as a person. So don't underestimate just being a good human and being quick and responsive, like John mentioned, and all of the little things, because it builds trust and their willingness to invest in you before they even know what the tech is going to be.
That's excellent. And John, over to you.
Yeah, I think of it as a lot of it is just blocking and tackling, like see who exited in your space, try and reach out to the founders. If they won't invest in you, maybe the group, they might introduce you to the people who invested in their company because they understand the space and have some subject matter expertise. So yeah, I just encourage people to be creative, and there's no shortcuts or secrets. I think a lot of it is what Cam mentioned, just going for it.
That's great. And I will pick up Maria's point. Certainly, please consider joining BC Tech and the community. You can attend some of our events to network. You can also apply to pitch at our pitch nights. You could also apply for Dragons One-on-One, where we put you in a room with a dragon, where they can give you feedback on your pitch and on any of the challenges you're facing. So make sure to we'll drop a few of those resources in the chat for people, but really do get involved. And lastly, we do have a Startup C Council that meets quarterly, and that's a peer-to-peer group where folks do share a lot of connections in those groups, and introductions. It's a really helpful space for founders. So please do reach out on any of those programs or activities to our team. So I have one final question to our panel. Obviously, we have some great, amazing startups on the line. It's been great reading about your work, and we think of you often and the great work that you're doing. You have big ambitions, and so for our panel, is there some final parting advice you could share with startups on the line who have big ambitions for their companies? And I'll come over to John first on this one.
Yeah, I'll just point to two things. I think building a business with especially big ambitions, it's not easy. It's a journey. Don't expect it to happen overnight. But I think it's be mindful of your physical and mental health as you go. It's very important to take care of yourself. If this is a 10, 15-year journey, and don't lose sight of that, have a support network that you can rely on, etc. And as I said, prioritize physical and mental health. And then to go back to something I said earlier, that I've just consistently observed with all the successful founders that we work with, they're just incredibly responsive. So just be responsive to employees, to customers, to investors, to everybody, and it just builds momentum over time. And yeah, as I said, it's never ceased to amaze me how responsive our successful founders are. So that'll be the one thing that I'd say keep in mind.
That's excellent advice. Thank you, John. Maria, what are your thoughts?
Yeah, I would say kind of three things stand out. A lot of what we talked about already that I think came up a few times, which is really spend the time to think through your vision, your story, how you're going to execute, and then how to communicate that. And communicate that, be responsive, communicate that often to your employees, to your customers, to potential investors, and kind of that always be ready, because you never know. And I would say the second thing is really spend the time on understanding your valuation. If you're not raising money, you need to make sure all this hard work that you're putting into your business is worth it. So your valuation is obviously revenue minus costs equals hopefully profitability at one point. So really spend the time to think through your valuation and what the company's worth, and therefore also those milestones if you do have to raise money. And then finally, just do the work, right? Focus on building the product, focus on building that economic value. And usually that last point will help with the first two. And it's probably, I'm guessing, your value as to why you even are your mission as to even why you're have started the business.
That's excellent. Cam, you get the last word.
Yeah, first of all, I need to update my bio because 15 years I think I'm lying. And I say that because I think I've seen 3 cycles of doom and gloom and over in my career in tech. And the one thing that is constant here is change, right? We're not going to go back in time to 2021. So what comes next is really for you to shape, and the relationships you're building right now, the way you treat people, the network you build, all of those things might seem like small things right now, but when the momentum comes back into the market, where investors are going to start writing checks, is for companies that they know and trust, and people and teams. So be creative, be a good person, think about how you're operating. It only complements this amazing tech that you're building. But I've been there, I've been in it. It's stressful. The same day can be the most exhilarating and the most depressing of your whole life, all in 24 hours. And that's just tech. And just think of the long term. And I think, John, what you mentioned there was, for me, is critical, is just take care of yourself, because you need your health to execute all of these things. And my last point, I was lucky enough to be on the board of BC Tech for years. It's an incredible organization, does great work in our ecosystem, and ties all of us together in ways that we kind of take for granted at times. So Erica, thanks for putting us together. It's a critical connection point. There's not a ton in our province and all these ecosystems. So thanks for doing the work you do.
That's fantastic. Thank you so much. Thank you, Cam. It's wonderful to have members like the three of you who we can reach out to for these sessions. So thank you for the time you dedicated today to share your thoughts with our members.